So today's Cardinal Lesson, we're talking about retirement income planning, really cash flow, paying taxes in retirement. But at the crux of it, people that come to us for financial planning, through working with us, they come up with an income need. And maybe more added to that, an income want. Maybe they get their needs taken care of, and then they have some want spending where they want to take some travel and give some gifts and spend money on things that they worked hard for. So you got needs and you got wants, but that creates a number. And in today's example, we have a couple that's both turning 65, and they've got quite a bit of retirement funds and other savings. And so we're going to be delving into specifically their income plan. And for today's show, we're going to be working mostly on the income, but we're going to be bringing in all seven worries because we're doing a full financial plan for Tom and Chelsea in the example here. And we're going to see several videos where you're going to see Tom and Chelsea over and over and over. So I want to push it to Tom, and I want Tom to talk about why we're doing this video today.
Yeah, I mean, we're doing this video because likely one of your biggest fears is running out of money, right? I'm talking to the people who've been good savers. They have money there, but they don't want to spend any of it because they're afraid, and you might be afraid, that if you spend too much now, you won't have enough later and you might run out. And so what we want to do is go through sort of a case study and show you how we can design something in a way that has it where you very, reasonably you're not going to run out of money and you're going to be okay sort of through the rest of your retirement. So I'll pull up the show notes here and we'll get going. We have these at the link below our video. They're also on our website. As always, we have the board, and then we have some slides that we sort of took screenshots of what we're going to look at a little bit later in the video here. So again, I don't want to spend too much time here because we'll get into more of the detail as we go through the show here. But again, if you want to print this out and study them a little bit closer, they have, again, screenshots of what we're going to look through. So I'm going to put it back to Hans. He'll sort of give you some context of what we have on the board, and then we'll just jump in.
Okay, so Tom and Chelsea, their situation is they have $750,000 of money they've already paid taxes on and what we call taxable investments. They have $2.5 million between both of their IRAs, or what were 401ks. They have $230,000 of cash, and they're needing to spend $12,000 a month. And so we build our financial plans or our income plans from the need to spend up. By that I mean is when we ask people how much do you need in retirement, a lot of people like this are going to throw at us a number of like $200,000 a year, okay? Because they're calculating taxes in there, and then they're netting 144,000, or they're going to say 220 or something. And so when we do the financial plan, we want to get to the spend. How much money do you need? And then we're going to put inflation on that, things going forward, make some adjustments at the older ages if you think it's appropriate. But in any case, we start with the spend, and then we build the taxes up. And most people are hiring us to try to lower the taxes or reduce the taxes over a long period of time. And we're going to do exactly that in this series of videos. So when we met Tom and Chelsea, when we talk about the current plan, they didn't necessarily have a financial plan. They just made the decisions of when to start Social Security, what accounts they're going to pull the money out of. They're going to delay taking from the IRA until they get to minimum distributions. And they're really trying to pay as little taxes as possible right in the beginning. And it's pretty easy to do that. But their current plan was by default. And Tom's going to show you later that their current plan, when you put these parameters in, would have a 90% chance of being successful or of not running out of money. And that a lot of that's brought on by these people have significant assets. Now, in the proposed plan, that's what I'm going to leave that to Tom to get in there, is he messes around with some of this, is delaying Social Security, creating a system to send them payments for the money that they need, creating a cash flow. So I'll let Tom get into that. I want to push it back to him, and he's going to show you and really get into the software that we use.
Yeah, I mean, so we'll bring this up here. I mean, this is going to be a very typical sort of process of what when we have people come in, they've hired us to do a financial plan. We go through this exercise with everybody. Now, everyone's looks different because their goals are different, their money's different. So this is just an example, but we wanted to sort of give you an idea of what this looks like. Hans had mentioned this. We're going to have several videos, essentially a series based off this Tom and Chelsea case study. And so if you want to get a better picture of what these plans look like, watch these after they all come out sort of in a row, and you'll get a sense of what how we help people. And so, like Hans had mentioned, I'm going to go through this pretty quickly because we have it on the board. They have about 230,000 of cash, about 200 in a high yield savings account, some in checking just to do their spending out of, but a nice sort of cushion there to cover sort of emergency expenses. They have some taxable money. Again, this is money that's outside of retirement accounts. It's in investments. For Tom and Chelsea, it's 750, and then in retirement accounts, they have about 2.5 million. I've just put it as one number, but you could be split up between two people. At the end of the day, it's kind of the same thing. They have a house. This really doesn't come into play too much in what we're going to go through today, but we can model all sorts of things in here. And so this is just a real simple example. We go to their goals. You know, they want to retire kind of January of 2025. Both Tom and Chelsea are 64 in this example. So they want to retire January, kind of right when they turn 65 of 2025. Their retirement expense goal is 12,000 a month after taxes, and then we have to inflate that over time, account for inflation. I'll show you in the software where it does that. And again, we want to show sort of the risk of needing long-term care. So the goal here, it's not a goal to need long-term care, but we want to show you if you need long-term care, what happens to the plan. This number it defaults to this number. It's the national average for home health care in today's dollars. Again, the software will inflate that cost to be a much higher number in the future. Again, their income, they're retired, so they're just now retiring, so they don't have any wages, they don't have any pensions, and so Social Security is their only sort of guaranteed source of income. We can plug in what they would have received at their full retirement age of 38.80. Again, the current plan is retirement 65, and I'll show you where we can play around with that a little bit later. Chelsea, again, she was a stay-at-home mom. She didn't have enough working history to qualify under her own record. So when she's going to file the spousal benefits when Tom files for his full benefits, or whenever that might be, either 65, full retirement age, or 70. Savings, again, this would be like if they're saving into the 401k, they're retired, so that's not super impactful. And this is pre-retirement living expenses, not real impactful because they're just retired, but it's the same matches they're spending 12,000 a month now and into the future. And again, the family one, this just shows you sort of their birthdays. Again, they're turning 65 in January. Their planning horizon, I do want to point this out. We have a planning horizon to 95. That's what we default to in our plans because we want to make sure that you have enough money if you do have that long life that you're worried about of running out of. Let's make sure we have money that can get us there. And again, Chelsea, similar age, turning 65 in January, again, planning horizon to 95. So when we're doing an actual plan, we go into more detail, more depth in this part, but I don't want to get caught up on this video of how to do that, but we'll build this out based off of your goals, your needs, your income, your money. I mean, it's going to be very customizable to you, but where we're going to spend most of the bulk of today is under this retirement tab, and this is where we can model different plans. And so these again are all different variables you can change. That the blue areas show the difference to the proposed plan and the current plan. But I want to focus on the current plan first, and so to show them where they came in before they met us, right? As they were going to retire, they were going to start Social Security. Again, you'll see the current plan is they were going to take it at retirement, and that was really all they had. But we're going to spend some time on this cash flows page because I think this is really helpful to look at this, and I can toggle back and forth between current plan and proposed plan. So their current plan, starting in 25, was go ahead and take Social Security. Thomas gets his benefit, Chelsea gets a spousal benefit, and then that just continues on into the future, right? You'll notice that number does increase over time. Social Security does get a cost of living adjustment, so that number does increase into the future. And then again, we have their spending goals, the 12,000 a month. And then again, you'll notice that cost going up higher as well because of inflation, as you need to be able to spend more in the future here. You'll notice there's a column here, planned distributions. We'll have another video where we get more into the Roth conversion piece of it because that is something we recommended for them. But you'll notice their plan was to delay taking money out of their IRA, live off of their cash, live off their taxable investments, which is what a lot of people do, and they wait until they have to start taking money out of their 401k or IRA via an RMD, a required minimum distribution. For this couple, that's 75 for them. So you'll notice is this planned distribution column is they're putting off money, pushing off money, not taking any out of the IRA, and then have to take a huge amount out of the IRA, projected to be around 200,000 at 75, and then that number, again, depending on the growth of the investments and stuff, grows over time, and it could really cause big tax hits later on. So we'll do another video more about that. But what we did from an income plan, because that's what this video is really on, is we looked at this, and they have the money, they have the resources to be able to afford taking Social Security. So when I go back to this analysis page, this is where we can model different things. Is you'll notice the proposed plan is the optimal strategy. What they call the optimal strategy is have Tom's delay till 70. Is let's get that highest check possible from Social Security. Between full retirement age and age 70, that check grows by 8% a year, guaranteed. And so you're getting a nice growth on that money by waiting. And then you get that higher check coming in for the rest of his life. And then if he does predecease Chelsea, the rest of her life as well, because of having that money coming in. So that's one of the first things that we talked to them about. One of the immediate questions they have, and this is very typical, is, okay, that makes sense, but how do I need money to live off of. Where do I pull that from? And that's where one of the recommendations we made was the use of a PIN mutual annuity. There's some information in the show notes on that. But specifically a SPIA, a single premium immediate annuity that only pays for 5 years. It's a 5-year period certain annuity. So it gives them a check to pay for the 5 years that they're delaying Social Security. So that was one of the recommendations we had, really to get them to be able to delay Social Security while getting them the income they need. When I go to the proposed plan, so I'll switch over to there now, as you'll notice this income is and we bumped it up a little bit to like 12,500 is what we solved for. So 150,000 a year coming in from this annuity, and that's coming in for the next 5 years. And then we'll get to the second annuity in a second. But that really gives them the income they need. We recommended they use most of their taxable investments. Again, if you remember, they had 750,000 of taxable investments. I think the annuity took like 670,000 or something like that. I could take a look. I'll go back and look in a second. But that's how much it took to solve for the 12,500 of monthly income. The reason we chose to use the taxable money and not the IRA money is because there's this idea in these annuities called an exclusion ratio. I don't want to get too far in the weeds there, but at the end of the day, a lot of it is not taxable to them. A lot of it is just returning their principal, so it keeps their taxable income really low, leaving room for Roth conversions, and we'll get into that on another show. But so that was one of the recommendations we had, and so you'll notice we have a much higher Social Security check coming in down the road. We got them the income for the next 5 years that they need, and then we have the second annuity, and this is really what helps solve for the fear of the lifetime having money there for the rest of your life. It's a indexed annuity that has an income rider that has the income guaranteed for the rest of both of Tom and Chelsea's life. And so it's guaranteed for as long as either one of them lives. It took about $1 million of their IRA, still leaving about $1.5 million being able to be invested and for long-term growth. But what we really have set out and done is given them an income plan that really removed their biggest fear, which was running out of money. And when people don't have a plan like this and they just start looking at their investments and trying to pull money out, is they end up underspending because they don't know how much they can spend and not realistically run out. And so they're a little bit worried about this. So this just gave them a lot of peace of mind to have that income guaranteed for the rest of their lives. I'll turn it back to Hans and see if he's got anything else to say here.
Yeah. Well, I'm going to try to. It's the first time I've really listened to Tom just kind of give that presentation, because most of the time I'm sitting beside him and the clients are on the other side of the Zoom and they're looking at the screen and it's their money on the screen, and that thing is going in the direction. The clients are asking a lot of questions and giving a lot of input, and there's a lot of back and forth. So when we do this for you, if you're interested in this, It's going to come at a slower rate, and we're going to be zeroing in on the things you're most interested in. And so what Tom did in the proposed plan is he talked about this is that by delaying Social Security, um, or another way to put it is what they were going to do is take it right away because they needed some cash flow coming in. And so what in the long-term picture, it was better for them to wait. And then what we have to deal with couples in this is that, oh, so now you're going to take my one piece of income, you're going to take it away from me, and I'm going to have to wait 5 years for it. Well, we're going to replace that with something that's going to send you a $12,500 monthly check starting next month. We're starting in January 2025 when you're retired, and it's going to be the same amount every single month for 60 months. And so 5 years. And so you can have the whole plan over here, and we're going to help you with that. And then this goes into your checking account, and then you're going to have a buffer in there. You're going to have a balance and a savings account, but you're going to have this to live on, and it's just going to come in like your paycheck did. And what was interesting about this is we're not going to pay much tax on that $12,500 a month, almost very little. And so there's a reason for that, which we'll get into. And when this stops at the end of the 60 months, then what we're proposing is that in the 61st month, we're going to start a guaranteed income. Um, this shows the annual amount, 112,100, but it's like 9,000 something a month is that's going to be guaranteed. It's going to start, and that 9,100 a month or 900,000, whatever it is going to last until both of them are gone. So if one of them, Tom or Chelsea, lives up into their 90s, this second annuity is going to be the best decision that they ever made. And again, this check is going to come in every month if that's the way they elect to take it. And they just know it's not going to stop until both of them are gone. And the reason it's gone down from 12,000 to 9,000 is we're going to have Social Security starting at exactly the same time. And the Social Security checks between the two of them, that's all in the software. And this still leaves a lot of their money available for investment, and we're going to leave it invested. If you run the numbers on this, of the 2.5 million of IRA, it's taking $1 million to buy this second annuity, which is about 40% of their portfolio. And so you can look upon these annuities, these income annuities, as a plug for bonds. And so, they'd be right on a 60-40 allocation. So we've just talked about the income piece today, and I'm going to push it back to Tom. Is there anything we really missed in going over this?
Yeah, I mean, from an income standpoint, I think we've covered most of it. Like Hans had mentioned, when we're doing this with clients, it's at a much slower pace, right? I went through it pretty quickly there's a lot to go through. But we spend some time in really getting to know you as the client and what you're looking for. And this just gives you an idea of what that looks like. But at the end of the day, really what we're trying to solve is get you to a level of income that you are looking for to enjoy the retirement that you're hoping for. And so that's really what we've done here in the income piece. There certainly are other things that we'll talk about on future shows. But if we just summarize kind of the recommendations we made from an income frames mindset was delay Social Security till 70. Purchase that immediate annuity that gives you the income that you need now, allowing you to live, to allow you to delay Social Security, and then a future income with another annuity that's in for the rest of your life. And when we structure all that together, it really just sort of solves for their base level of income needs, what they were looking for from guaranteed sources. And so that what's nice about that is it's you don't have to worry about market fluctuations. You don't have to worry about market downturns. Now, a lot of their money is still invested, but they can take more of a long-term approach to those investments, allowing them to grow. And that's maybe where the legacy piece of their plan is coming from, what's going to be left to their kids. And again, that's where sort of Roth conversions come into play, which we'll do another show on that.
Yeah, and speaking of Roth conversions, that's going to be the next show. So that's going to come next week, and we're going to take Tom and Chelsea, the same plan, the same example, and then we're going to focus on not only what we're doing in Roth conversions, but why we're doing it, and we're going to show the end result. So that's going to be covered next week. We talked a little bit about it today. We're in a future show, we're going to talk about solving for long-term care and coming up with a solution for that. We're not really in this show, in this series, going to focus too much on the state, but there's certainly every show is going to be talking about taxes. And when we do a plan for people, a financial plan, a retirement plan, it encompasses all 7 of these. And I didn't check Social Security. We've been talking about that today, and we'll keep talking about that through the whole series with Tom and Chelsea. So that being said, I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.